Okay, hello. I hope this trading course series video will find you well. The first thing that I would like to do is to thank you for trusting in me and believing that maybe I'm going to help you to turn around the corner through your trading journey. This is a good place to be. I think this is the last trading course that you are going to need through your trading career. So this trading course, mainly I will be majoring on forex, but you can use it to trade anything you like. It might be metals, stocks, indices. I have a lot of people asking me, can I use the method to trade volatility indices? I say, of course, you can do, as long as you understand the basics, the fundamentals of the course. Okay, so my name is Tanaka. If you don't know me, that's my name. Okay, so let's get started. So the course outline is going to be broken down in 4 parts, where part 1 will talk about introduction to market makers method, how to win in trading, objectives of the market maker pattern, the trading hours of when you should trade, and the daily, weekly, monthly, and the yearly cycle. So these are cycles that plays out every day, every week, and every year. So we have a pattern that repeats itself over the course of the year. So from there we'll go into part 2, where I'm going to talk about candlesticks, the pattern variations, and the London type patterns, where we have type 1, type 2, and type 3. Then in part 3, I'm going to talk about trend levels, some level 3 behaviors, and etc. So the last part will be part 4, where we will be putting everything together on how do you look for an entry in some entry rules, how do you manage your trade, and finally we'll look at some indicators. In this trading system, I really don't use trading indicators as my signal. I use them as a confirmation. So price action first, candles will follow. Okay, so market makers method part 1. So this part 1, like I said, is the one that we're going to do today. Tomorrow we're going for another part 2, part 3, part 4. So it's going to be a 4-day series, broken down in 4 parts. So the truth about the market is that the forex market is manipulated like any market. You might ask, who manipulates the markets? These are called the market makers, the guys who make the market. So these guys, what they do is that they create every price chart you have seen and every price chart you know that exists in the market. So when you see gold rising, you should know that these guys they are raising the price of gold. Okay, so like I was told and read in some book that I read, it said that it takes 10,000 lots to move the market by 1 pip. So 10,000 lots on a standard account, that's a lot of money, something like more than 100,000 to move the market by 1 pip. If you have taken time to watch how the market moves and how it behaves, you see that the market fluctuates very fast. 1 pip, 2 pip, it will be fluctuating very fast. So there's a lot of money involved. So at the end of the day, we have retail traders versus the market makers. So finally, we have 2 sides, where a trader like me is being up against some other guys called market makers. So what will happen is that every time I buy, this guy sells, because for me to enter in a deal, in a trade, someone has to feel in the opposite direction of the trade. So these guys will sell to me the moment I buy. The moment I sell, they will buy from me to create the balance in the market. So when I lose money, these guys, they make money. When I make money, these guys, they lose money. This is the reason why 90% of people lose money. Is because they are trading against the market makers. They don't know what the market makers are. Okay, so this will cause them to lose money because they don't even understand the fundamentals of the market, the basics that I'm about to give you today. Okay, so a continuation is that the market maker cycles and patterns are found on any time frame in any instrument, and these things they are repeatedly and unseen by an untrained eye of a retail trader. So for example, it's hard to see something that you are not looking for. Okay, you're just walking down the road, and maybe there's a pen inside on the road. Okay, it's hard for you to see the pen, especially if you were not looking for that thing. So but my promise today is that this thing will end today, since we're going to break down and kick the market makers or start from zero. I'm going to teach you how to do everything. Okay, so let's so on trading with the market makers, you need to understand who exactly trades the markets. Okay, like I said, we have some market makers, retail traders, some banks. Okay, so based on this sheet shown on my screen right now, I have top 10 current traders based on percentage overall volume from the year 2016. As you can see, these are the top 10 banks in the world, and they trade these share percentages of the daily volume. Okay, so if the daily volume is 5 trillion, these guys, they are trading 12.9% of 5 trillion is their money. So if you add up the 10 banks, the guys will have a total of 60%. So as you can see, more than 3 trillion is owned by 10 banks, and so they have a lot of money that they can use to manipulate the market at any given time, and they have a lot of resources. I'm going to show you everything and how they do it, how they look like. Okay, so the market maker, this is the pattern, sorry, this is the picture of how these guys look like. As you saw from the last, this one, this is UBS. Okay, UBS, it's a bank from Switzerland. These are the traders who trade for UBS. As you can see, these are professional traders, highly trained. The room is very big, very big, very bigger than the city or in my city where I live in. The city was something like this, half of the room. They have a lot of traders. This is not the only dealer that has the room which is bigger like this. Each and every of these dealers, they have rooms which looks like this one. Okay, so this is UBS again. I think this was before this picture. As you can see, the computers inside this room, they were, this is an older version of computers. As you can see, some CRT screens. Okay, and then this is Morgan Stanley on number 10. These are professional traders from Morgan Stanley, as you can see. So these guys, they don't lose money. The moment they lose money, you get fired from a job working for the bank. Okay, so unless you want to lose your job, that's when you lose money. So technically, these guys, they rarely look at charts. They are the ones who create charts. They are only looking at the orders in the market. Okay, the other thing is that when these guys make their decision, they don't make their decision based on candles like we do. They make their decision based on the amount of open float in the market. So for example, if we have I would say 20 billion. Okay, I hope you can see the red color clearly. Some people say that they have eye problems with red. Okay, so if we have long 20 billion long, okay, so 20 billion are buyers. Okay, and then 11 billion is short. Okay, think from the perspective of the market maker. He needs to make money. Which direction should we move the market to? Obviously, the market will drop. He will punish the long holders, or the long holders will be punished dropping price making sure that the sellers will make profit with him, or punishing all the long holders. Okay, so he's going to punish the long holders, making sure that all the people who were buying, you choose to take 20 billion than 11 billion. I think it makes sense what these guys do. Okay, so I think this is one of the most important slide in this series. Okay, so the market makers create a sentiment and act against it. So what they do is that they create a buy sentiment and act against it. So after creating a buy sentiment, having more buyers, they will start to sell, making sure all the buyers are crushed in the market. So they create a sentiment and act against it. They also use the news and rumors to perpetuate the market, taking out your money. So you will see that today's news, it was positive. The trend is up. Potentially you're at a peak. They will use everything to make sure the crowd goes the wrong way, they take the other side. Okay, so what they only need to do is that they need to make sure that they have enough amount of fish inside of the net for them to take and reverse the market. Okay, so basically, how can you win trading? It's simple for you to win. The first thing that you need to do is that you need to identify the pattern and trade in line with the market. As long as you trade offline with these guys, you need to be in line with them. That's the first thing. So every time you see you trade in profit, you need to know that, okay, I'm in line with what? With the market makers. Every time you see yourself in loss, you are going what? The opposite way. The other thing that you need to do, which is what I'm going to train you or teach you or share with you, I don't know how you want to accept it, is that you need to think like a market maker. How would you do it if you were a market maker? So think like a market maker and you will make money. And finally, these guys, they don't have one pattern which they use. They have a lot of variations. A lot of factors will be involved so that they can trick us. Okay, so they have a lot of variations. So how do you beat the market maker? Like I said, in order to beat the market maker, you must understand what their objectives. What is their objective? Why do these guys come to work? They come to work to make money. Okay, how do they make money? They make money by tricking us. Okay, so you have to think like a market maker, the guy on the other side of the screen. This is what I'm telling you to do. Don't ever think like a retail trader. The moment you think like a normal retail trader, of course I'm a retail trader, but I think like a market maker. I know what a market maker does. That's the thing. So these are some of the objectives of the market maker. The objectives of the market maker are to induce traders to take positions. So if you have $1,000 sitting in your account without clicking a buy or a sell, you just have $1,000. This money has no use to the market maker. So what you want to do is that he needs to induce you to buy or sell. Then he will do something to make you lose. Okay. So the other thing that they will do is that they will create panic and fear to make traders think irrationally. Okay. So some fast movements, you see them. The last thing, which is what they want, why they come to work, is to hit your stop loss and clear the board. He does not want anyone to make money. If you make money, these guys, they will always make money every day, but they won't be happy if someone makes money. I was told a story of a guy who was who the market makers, the big brokers, these big guys, they said, no, you can't trade in here, we are putting you out of our room. So they kicked him out from the broker because he was making money and he was making these guys suffering. Okay, So this is what will happen. So the last thing is that they'll force traders into margin call and pocket the money. So margin call is when you over leverage your account and you have less money to cover up your trades. Most of us we know this, like we say, I've blown my account. I don't know how many accounts have you blown. Please tell me in my email or my phone number. I'll put it at the end. If you have blown an account, I need to know, and I'll tell you what to do, and you will know it, and you will, I promise you, if you do exactly as what I say, it will be hard for you to blow an account. So these guys, what can they do inside this room? They can manipulate the market. What can they use to manipulate the market is what we have to see. So these slides were taken from MetaTrader 4 Manager User Guide. This is the user guide that the manager who manages MetaTrader 4. So you manage a lot of people's MetaTrader 4s, and these slides will show what these guys will be looking at. So they can record you at will. If you try to end up at a certain price with a heavy lot, and he sees that this guy is going to make money, they'll simply just click reject. So you are not allowed to enter in a trade. This way the arrow is pointing on reject. You are not, they reject you, you are filled on another price. So they can also control the spread. The spread is the difference between the bid and the ask, which is the commission which you pay to your broker as soon as you enter a trade. This is why scalping fails, and why many robots fail, because you can increase the spread at any time. You just push the slider in here, and the bid will move into -4, the bid will be -2, sorry, -4, and the ask will go to 4, the spread increases to 8. They just have the plugins inside their computers where they can manipulate the markets. They can stop you at anyone who is available at that price, who has his stop loss at that price. You just simply click on stop out, say unlimited, and it's done, guys. They click OK. Everyone at a certain price point is taken out. As you can see, this is in different languages. I think this is Russian. I don't know. I think it's Russian, but the concept is the same. There are many dealers. Some are situated in China. They will have Chinese. Some in Asia. They will have their own language which they use there. So you can also hold the price level so that it's visible on the chart. You can see, so these guys, they can create candles. As you can see on this chart, this is a bar chart. You just simply punch in the date, the open, the high, the low, and the close price, which I explained on the previous first video where I was explaining on candlesticks. And you put the volume, and it's done. If you feels like he needs to change it, he comes back and changes. And he knows who is about to blow his account. This is margin trouble. On margin calls, you can see at this level we have certain amount of money. Let's go and blow the accounts, these guys. Okay, so on margin call, they can blow your account. They know he's on the fence. Specifically, there's a trade designed for this. It's called a straightaway trade. I'm going to show you the straightaway trade, tell you how you can enter on a straightaway trade. Okay, so this is what he's looking at. This is his computer, the MetaTrader manager. As you can see from the top in here, everything that I showed you from the previous slides will be presented in here. Margin calls, these are orders, these are the pairs, these are his clients, and he can shift. There's a lot of things that these guys have. Okay, so I need you to understand that as long as you are trading, you are playing their game. You are inside their house. Okay, so the only way you can win is by studying how they play their game, and you can play like them. Okay, so the only way which you can do it is by using the chart, which is their footprint, and you can follow them. This is the simplest trick which we can use Just look at the chart, look at their footprints, just follow them. He's about to move, you move. When he moves, you move. Okay, so how do you beat the market maker? Like I said, you need to understand his objectives before. Objective number one, I said he need to induce you to take positions. Okay, so they will do secular trading, which is trading inside the range. They widen the range and make sure anyone will pick up a position so that he can evaluate his book and see that, man, I have 20 billion selling, I have 10 billion buying. Let me buy the market to punish everyone. Everyone selling. Okay, so the objective number two is that he needs to create panic, fear, and to make you think irrationally. How many times have you entered in a trade and suddenly a spike candle comes in and you are in a loss? Some of you move your stop loss, you cut the trade. A lot of things, a lot of people react differently. I have been in the same position before. So this is done by quick moves, some spike candles with the news, inexplicable price behaviors. You can't explain what is happening. You think price in support is on support, it breaks support very fast, and man, it blows your account. Okay, so the last objectives, which is why they come to work, is that they need to hit your stop, clear the board, force you into margin trouble, and pocket your money. It needs to make your money it needs to take your money. If you cannot take your money, it means that he has done nothing. So why is he being paid to come to work? So your duty as a trader is to understand how to read these moves, anticipate when and how the moves will present. Then you can truly beat the market maker by trading in line with him. When he buys, you buy. When he sells, you sell. When I move, you move. I hope it's clear. No mistake. When he buys and you try to sell, you'll see it for yourself. Your account will start to be in a red. Your trade goes red. Okay, so like I said, the market maker will need to make some trap moves. These trap moves are made at the beginning of the week, beginning of the day, beginning of the session, end of the week, end of session, end of the day. So let's consider this line to be the beginning of the week. Okay, price has been rising from here, entering into the new week. Many people are in the buy sentiment. You need to trap people at the beginning of the week. So you will continue to rise price in the week beginning. More people are still buying. This is a week beginning false move. Okay. More people are still buying. After years, enough money of people buying, you sell price. Okay. The opposite is true. The opposite is for sale. Okay. Into the new week. The false move is like it's self-described. I don't know the word to use. Okay, like when I say it's a false move, it's a move before the real move. So if the real move is to drop price like this is the real move. Okay, which he needs to do in the week. The false move is this one, which is to rise price. So if he wants to rise price the whole week or the whole session or the whole day, this break line here represents the beginning of the day, beginning of the session, end of week, end of what? End of the day. So what you do, you come in here, induce more people to sell, then come in here. Okay, the same will apply to the end of the week. Okay, so this will be our weekly line. So price has been rising for the whole week. Okay, going into what? Into Friday, you induce more people to go long, then pull price off in here. You end lower, and usually you use a gap to cover up and make money. For those of you who have traded, and if you have not traded, I need you to go back into the charts, go and try to look at almost every week beginning, day beginning, there's a gap that is created. The shitty thing about the gap is that if you have a stop loss which was inside the gap which he created, okay, So let's say you entered in here, your stop loss is here. If he jumps, the price is around here, okay? If he jumps and comes in here, you will jump your stop loss. If your stop loss was at minus $10, this was your maximum loss. You will see when you come on your terminal on Monday that you have minus 70. How did you do that? It's written in the sections. Where on the market open, the dealer can offer you the first price available. This is their trick. So they added the gap to their arsenal, so anytime they can gap you and make money. When they gap you, usually this is when they use the margin call to blow your account. The market maker pattern, like I said, the footprint of what they do plays out on all time frame. It is seen every day, every week, every month, and every year. This thing will be seen. Okay, so it exists on every time frame, on any instrument. Even on a weather chart, you can see the pattern as long as the thing measures the high and the low. Okay, you will see the pattern that I'm talking about. So the segment that I'm going to enter into now, this is the most important segment of this trading course. If you do not understand what I will say next, please do not try to move to the next segment before you understand the pattern. This is the whole fundamental where the class is based on. Okay, so I will now draw you the pattern and explain to you why does the pattern look like this. Okay, so let me pick my pen. Let's start. So the pattern will begin from the break. Okay, this pattern will show on daily, on weekly, monthly, yearly, quarterly, semi-annually. I don't know what you call it. Okay, so now I'm going to consider this as a 24-hour market cycle, which is the daily cycle. So what will happen within the daily cycle is that at the beginning of the day, which is 5 p.m. Eastern Standard Time, the times that we will use, we don't use the broker's time. Make sure the times that I will tell you, you will convert them to your local time. Okay, so these times are in New York time, Eastern Standard Time. Convert it to your local time and understand how to map your own broker. Okay, at the beginning of the day, price will begin in what? In consolidation. Okay, price will consolidate, something like this. The reason why price consolidate is because the market maker is accumulating contracts and you need to evaluate the contracts. Usually, typically 70% of the times, this will be what? The Asian session. Okay, the pattern is the most important thing. I'll tell you the other most important thing when I finish the pattern. I hope I will remember that. The most important thing being the pattern. This is what? The accumulation phase. The market maker is accumulating contracts and evaluating. So towards the end of the Asian session, beginning of the London session, okay, you widen the range. Okay, price will come here and come here. The reason why you widen the range is you need to pick out the breakout traders and make sure you whipsaws them out. Okay, so what breakout traders do is that they go on the range, they place their sell stop, their buy stop in here. So it comes in, triggers the buy stop, triggers the sell stop in here. Okay, so after that, towards the London session, this is where the false move will come. Okay, the false move will come in 3 pushes. The 3 pushes can be in 3 candles, 5 candles, 8 candles, 1 candle. Sometimes it can be a gap. Understand that. Okay, so the 3 pushes will come. This on this day, let's say the market maker wanted to buy price. Okay, so he wanted to rise price. So the first move was what? A down move. 1, 2, 3. Okay, this will be 1, which is our first move. 2, this will be what? Our 3. You create a law of the day. Okay, so what has happened is now anyone can see that price is dropped 3 times, and a lot of people, when they see anything 3 times, they believe it. Think of this. How many times back then, when I was around the form 6, 17 years, 18 years old, I used to go to the betting house. I used to bet on dogs. I would look for a dog that would win 3 consecutive times, then bet on it. Okay, most of the time I lost the bet. So there are people who believe in anything as long as they saw it 3 times. This is what will happen. You see that price is moved down 3 times. You believe that now it's a sale. You try to sell. The dealer will pull back in here. Okay, so everyone who was selling in here, he will be what? You will be cleared out by this move in here, creating a V. Okay, so what has happened in here, after he creates this low, some people will buy on this. He can't take them up. He needs to make sure that he clears what? The board. He will come back again in here. It will depend on the volume, whether he passes the law or he does not. If he has trapped less volume, he will break the law. If he did not, if he trapped enough volume, okay, he won't break the law. But if he did not trap enough volume and he still needs to trap more money selling, you break the law, coming back below in here. Okay, what this will do is that a lot of people who have lost their money on this move will now start to add to their positions. Okay, so they will now be what? Selling as price breaks on this low. Okay, after creating the low, which is the W second leg, this is the first leg in here. This is what the second leg. As soon as it starts to rise in here, this is where we will enter our position in here. This will be what? Our entry in here. So you are a buyer in here, your stop loss goes below in here, your target, you put it on the top. Okay, so this is our entry. We are now a buyer. Okay, so from the low in here, you create another 3 moves similar to this one, which will be the trend run, the trend of the day. Usually this move will be 6 to 8 hours. Okay, so price will rise into level 1. Some people will start to buy in here as they see that price is what is rising. You will then pull back, clears off anyone buying, induce more people to sell. Okay, price will move into 2. Okay, more people will buy, like I said before. Okay, it then clears the board and does the third move. Like I told you before, there are many people who believe in anything as long as they saw it 3 times. I told you my example on the bet shop. Think of this. Someone comes to you, tries to convince you to buy something. Okay, the first time you reject, he comes back the second time. Maybe it's now a different person is telling you about the same thing which the first person told you about. You reject. Now your father, or maybe your mother, or maybe someone whom you trust comes back the third time. So you have heard this thing say, man, buy Euro USD, buy Euro USD the third time. Okay, which happens to be a peak. You now believe that Euro USD is buying. That's where you get jammed up. A lot of people will start to buy, adding their positions in here. They are what? They are buying. This is a clear uptrend, and then price pulls back, creating a V. Okay, what will happen next is that you induce you to go long again, making sure anyone who have sold in here is taken out, and he needs to induce more buyers in the second move, making an M, and he will drop price in what, in 3 moves back into what, into consolidation. So as long as you can count up to 3, trust me, you will make money in forex. As long as you can count up to 3, I think everyone can count up to 3. It's a simple thing to do. 1 2 3. So here from the low, 1 2 3, 1 2 3. So we'll now end into the what, end of what, end of day in here. This will be our end of day. Okay, I hope the pattern is clear and you can now understand. So if we were going up, it's the opposite. The first move is up, 1 2 3, it creates an M. It goes down, 1 2 3, it creates a W, repeats the W, forming the second leg. So this is our first leg, this is our second leg, sorry. Then it drops price into 1 2 3. Okay, so let's measure these moves and let's see how big and their sizes. Okay, so the size of the stop hand, which happens to be the stop hand, which is the false move, this 1 2 3 in here, this whole move, this one to the low of the day. Okay, the size of the move, it's what, 25 to 50 pips, depending on the pair. If the pair is a low ADR, the stop hand will be low, and then if the ADR is high, the stop hand will be high. Okay, sometimes you can see that on pound odd you might see a stop hand of 80 pips. It's because the ADR on that day is 294. Okay, it will happen. Okay, so from the low of the W in here to the high in here, this whole move here, this is what we call the daily range, which is the average daily range which the dealer is allowed to move. So each pair has its own average daily range where the daily cycle is expected to move, what the daily cycle is expected to move. So if the average daily range, which is the ADR for Euro USD, is 50 pips, when the dealer reaches 49.50, okay, you will start to look for reversal and start trapping people on the other side. That is what will happen on this thing. I hope you now understand the daily cycle. This pattern, we will see it daily, weekly, monthly. I will show you the charts, it will appear. Okay, so one more time, going the other way. Okay, consolidation, which is the accumulation phase of the market, the first move beginning at the beginning of the session, 1 2 3, creates the high of the day, drop price, clearing the stops of anyone buying, induce more people to buy, drops price in what, in 3 levels. You will reach the average daily range, the limit, then you will pull back, clearing stops, induce more people to go back into the range in what, in 3 moves. This is the daily cycle, the weekly cycle, the monthly cycle, the whole fundamental of what the course is based upon. So if you did not understand it, guys, I hope maybe try to contact me, but before you contact me, repeat this thing, because this is the most important thing of the cycle. So usually this will be the Asian session, this force move will come towards the London session, we'll get a trend run in London session, the reversal will come towards the New York session. Okay, so let me put some break lines for you. This will be Asia usually. Okay, Asia, we'll go into London in here. This will be London session. Then the US session will come, we'll get a what? A reversal. So let me move to the recharts and show you what I was talking about. So we have some market conditions, like I said before. I told you we have let me pick a pen. Which color is good? Red. We have some market conditions where I told you that the first market conditions is what? Accumulation. We are inside a range where the initial low and high are set by the market maker, and the market maker is collecting contracts. He needs to collect contracts before evaluating and start to move the market. You can't move the market when it does not have contracts, because he's wasting his money. Okay, so the stop and will come, which is a 1, 2, 3 false move to the high, pulls back, create an M formation, which is the trap. This is a trap, guys. A lot of people will see this as a continuation, but for you now, you know, don't see that as a continuation. It's a trap. Okay, a high is created. Now we want to start our trend run, which we usually sorry, I skipped the stop hand. Like I said, the stop hand is the false move out of the accumulation zone against their real intention. So our stop hand 1, 2, 3. I said the stop hand can be in 3 candles, 5 candles, 8 candles, 1 candle. These are only 3 moves. If you do your homework and start the charts, which you are supposed and need to do, if you don't do that, you'll be doing yourself a disservice. It will cause you to lose money. Okay, they will start the trend of the day in 3 moves, approximately 6 to 8 hours on a typical cycle. Okay, 3 moves, creates the low, pulls back into the range in 3 moves, which is the end of the day. So like I said, I told you the market conditions. These are the conditions that you need to look for. So what you need to do now is to wait for the market maker to show you something before you buy it. Don't anticipate and trade in the stop and wait for him to show you the stop and create an M formation. Then you are now what? A buyer or a seller. So after he creates this leg in here, white is better, black I think is good. After he creates this leg in here, okay, you are now what? A seller. He drops price 3 moves, comes back, creates a W on this leg, you are a buyer. I hope it's clear and it's simple to understand. I hope I'm making it clear for you. So let me move to the next slide. So like I said before, a typical day is 3 main sessions. Okay, the beginning 5 p.m. Eastern Standard Time, which is the Asian session. 3 a.m. Eastern Standard Time, we'll go into the London session, which is 3:30 exactly. 9:30 Eastern Standard Time, which is the New York time, we'll go into the New York session. So these are the trading times. You need to know them. Don't use the time at the bottom of your MetaTrader 4. Please don't. Make sure you take these times, convert them to your local time. A lot of people will live in different countries. Each country has its own time zone. Make sure you convert these times. So 5 p.m. the high and the low is reset. 5 p.m. to 8 p.m. we enter into dead gap. Usually there is nothing happening in the market. We have the cycle in here. So now this is the dead gap. We will now enter into the Asian session, okay, which happens to be the accumulation phase. For the Asian session, this is to be less than 50 pips, the Asian session. Okay, as we enter into the London session, we'll see a stop hand, okay, creating the low of the day towards inside the London session. Sometimes pushes price 1, 2, 3 to the high, pulls back, repeat the high, This will be towards the New York session. Price drops back into the range end of the day. So Asian session will start at 8:30 to 3 a.m. Okay, then from 3:30 to 9:30, from 3:30 to 9 a.m. we have the London session. From 9:30 to 5 p.m., which is the end, which was the beginning of the Asian session, we have our New York session into the end of the day consolidation. If you clearly looked at these times, from 3 a.m. to 3:30 we have a 30-minute break. This is called gap time. Okay, so what is happening between the gap time is that the market maker from the Asian session is telling the market maker who is coming into the next session, which is the London session, what he had and what he's supposed to do. So he's telling him, man, I have 4 million bucks trapped long. You need to rise price, trap more people, then reverse at 61.40. From 9 a.m. to 9:30 a.m. before the New York session begins, 30 minutes is fed the data from the London guy. He now knows that, hey, man, we have this, we have more people trapped long now. Let's trap again, which is the false move session beginning. Okay, towards the New York session. This will be a false move session beginning. It seems like he's rising price, then he suddenly drops it. Price will go back into the range. Okay, this is the fundamental of the market timing. Okay, like I had forgotten, the most important things of the trading system, this system. Okay, the number one thing is the pattern. Okay, the pattern. It's hard to write, guys. Oh shit, that pattern. The second most important thing again is the pattern, the same pattern which I told you to remember on that black screen. Okay, make sure you know the pattern. The third important thing again will be the pattern. Okay, now we'll come to the fourth important thing, which is the timing. This is why I gave you the times. I know some of you, you know, you have these times. Don't look at those times where we have some ribbons. We have Sydney session, a lot of other sessions. There are 3 main sessions. These are times that I gave you are the keys to the city. Don't look at any other time frame. Sorry, don't look at any other times which are out there. Those are garbage. Okay, so the last thing which will come, which is number 5, is the levels. Okay, the levels. So the levels are a distance 50 from the number 4. As you can see, these are close. There is a distance. The levels are a distance 50 from the thing. And lastly, the number 6, this is where we use the indicators. Some of you maybe had been trading using indicators. The number 6 thing will be our confirmation indicators. I hope I told you the most 3 important thing: the pattern, the market maker pattern, consolidation, stop and false move, M formation, drop the price 1, 2, 3, create a W, back into the range after 1, 2, 3 moves. Okay, I hope you now understand that. Okay, so the phases of the market, like we said from the previous, we have consolidation in here. We now have the induced trap and shift phase after the consolidation. So it induces you to buy. Okay, it traps you with an M. Okay, it shifts the zone out of there. This is our shift. You will now drop price 3 levels of drop or rise, depending. If we're going up, it was going to be something like this: 2, 3, creates a W, 1, 2, 3. Okay, so it now creates a W, rise 3. If the low is an M, the high, if the low is a W, the high is an M. If the high is an M, the low is what? A W. So these are the patterns. I hope you will be able to memorize this picture, this pattern. It's simple. I taught this to my grade 4 brother. He understood it very well. He now can trade in line with the market makers, guys. Okay, so you can do it. If a grade 4 person can do it, you can do it. All you need is to roll up your sleeves, understand this thing, dig it up in the market, and then you are doing yourself the biggest favor you will need. Okay, so my next slide is the boxes. So with these boxes, we have to define each and every box first. So sorry, let me pick black. Yellow is hard to see. This is in our Asian box. Okay, so 5 p.m. here to around what? 3. Okay, the 1 a.m. It's not 3. This is 5. This is 1 a.m. New York Eastern Standard Time. Our Asian box. Then the gap between here, this is 25 pips. So you don't need to measure to see if you have reached 25 pips or not. This one is 25 again. So from the top to the bottom here, it will be what? It will be 50 pips. You create what? The high of this box. Same to the low. This box in here is the beginning of, this is the London session. Okay, London brings shadow. We use this box to identify what is called a Brinks trade. These two boxes in here, we use them to identify the Brinks trade. Okay, then the red box is what we have for the New York session, Asian session, London session, New York session. I hope the boxes are clear. So this is how the pattern presented on this day. Asian session, the range I told you, it need to be 50 pips. 52.9 is good. Okay, as long it shows that price is what is in consolidation. You widen the range then back. Okay, what will happen? We have our first move to the downside. Okay, 1, 2, 3. We have reached 50 pips. Like I said, this has to be what? 50 pips. Okay, creates the low, pulls back, repeats the low into the London session. Okay, price needs to rise 3 levels, 1, 2, 3. Okay, after this I'm sorry guys for with my drawing. I bumped my angle on the table. So what has happened? Price is risen 3 times. Those who believe in something, as long as they saw it 3 times, start to believe price is rising, it pulls back, okay, into the London session, into the US session. Sorry, you consolidate towards the false move session beginning, you drop price 3 times again back into what? Into consolidation. This is our daily cycle. This is how the cycle will present over the course of 24 hours, over the course of the day. This is the daily cycle. Let me open the next slide. So this is the slide with the times correctly labeled. So 5 p.m. in here, where I have this, we have the beginning of the Asian session to 1 a.m. We have 3 to 4 a.m. the London session in here. The London session will begin on the mid line, on the mid candle. Like as you can see, we have 1, 2, 3, 4, 5. On the third candle, this is the beginning of the London session. Same with here, this is the beginning of the New York session where the red box begins. Okay, so from 9 to 10, we have our shadow box pending, and from 9:30 a.m. to 1 p.m. okay, towards the end of the red box, this is the end of the what? The New York session. I hope you can understand the session timings and be able to follow me on this. So like I draw this for you, this is a clear market maker pattern. Okay, so what do we have in here? Asian range 18 pips, correct? Okay, this is what we call consolidation. Okay, We will now have a vector move going outside the box. 1, 2, 3. 3 candles to the low of the day. He hit the 25 pre-measured box in here, so we know that price is reached the low. Price pulls back, taking out everyone trying to sell. He then repeats the low in here. Okay, if you can see, he passed the low here. Why? He needed to induce more people to sell and cleared some stop losses of the other people who were weak in here trying to buy this thing. Okay, price will rise for 3 levels in around 6 to 8 hours. 1, 2, the third move. The third move will come into what? The New York session. I told you this box here represent what? The beginning of the New York session. As you can see, the second leg of the W was inside the London session. The second leg of the M is towards the beginning of what? The New York session. These are what we consider to be a Brinks trade. So a Brinks trade is a trade where the pattern and the timings will line up. In a Brinks trade, you have a second leg being formed out at the session opening. Okay, so Brinks trade, you have something like this. Okay, this will line up with session opening. Price will rise 3 moves. This will line up with session opening. Price will drop. So if the pattern lines up with the fourth important thing, which is the timing, that is called a Brinks trade. Let me repeat this for you again. Consolidation, false move 1, 2, 3, pulls back, repeats the low 1, 2, 3, creates an M formation. You drop price in here 1, 2, 3. Okay, you enter into a range again. This is not that clear, but you can see what I'm talking about. Okay, so this slide in here, we're going the other way. We have consolidation Asian range 28 pips. It's pre-measured. It's okay. Our stop and move will now begin in 3 candles. 1, 2, 3. If you looked, they are inside the shadow box of what? The London session. So we have the dealer making a false move at the beginning of the London session. Price pulls back, repeats the high, and trying to induce more people to sell, taking everyone, trying to inducing more people to buy, taking everyone who was selling in here. The reason why it did not drop and kept lingering, hanging around in here, is that the contracts were not straddled the way he wanted. So he's still inducing more people by holding the level. You drop price 3 levels. 1, the first drop move that we can clearly see is up to here. Then we have our second move, the third move back into what? Into consolidation. So this was our 1, this was our 2, this was our 3. The first move, if you look at why I said this is 1, we have 1, 2, 3, creating the first move inside 1, 2, 3. So each of the moves, we have 3 small moves inside of it. I'll tell you more about that. The same applies to the low. Asian range consolidation 20 pips. Price makes a false move to the downside, hitting the pre-measured 25 pip box. Okay, pulls away, repeats the low. The reason why it did not come back to this recent low is that it did not want to release the trade volume and induce more people to sell it enough money. Okay, so price will rise in 3 moves, which will happen to be 3 levels. Consider the first move being aggressive, the second, the third. This is not 6 hours, guys. I told you, but if you look 1, 2, 3, 4, 1 hour, 1, 2, 3, 4, 2 hours, 1, 2, 3, 4, 3 hours. 3 hours and 15 minutes is done with the trend. He creates an M formation in here. The green bar goes up, pulls down, repeats the high, and I think you can see an M formation inside the candles. If you were to switch that to a line chart, you would clearly see that there is an M formation. The same principle applies to this. On this chart, it did not create a low, an M or a W, but I want you to see, do not trade something like this. Only trade second leg M's and W's. If you try to trade something like this, this is where you will lose money, because you are trading what, the first leg. But as you can see, it's 1, 2, 3. Okay, repeat the high. You will start to drop price in 3 levels: 1, 2, 3. So 1, 2, 3. Creates the low. So this is what, high of the day, HOD. This will be our low of the day, the LOD. From the low of the day, it now needs to go back into the range in 3 moves: 1, 2, 3, 1, 2, 3. Okay, so price goes back into the range. If you can see on this range in here, there are more spikes to the bottom, these pins in here, than the top. It's because he needs to trap more people buying in here. So it's like selling price, selling. Anyone selling, he pulls off. People start to sell, he pulls off. People start to sell, he pulls off. That is his game, to trap you and make sure you won't make money. When you make money, he's not happy. Okay, let me explain to you what I have here. I hope you can see my red cursor. It's on the left corner in here. I'm pulling it. So this is our trading range at the beginning of the Asian session. This is the range. As you can see, it's a tight range. Market maker induced shorts by breaking the 50 and the 200 EMA in 3 moves. Okay, 1, 2, 3, creates the low in here. Okay, so we now have the stop hunt. After the stop hunt, he now needs to shift and trap people who were trying to sell this. Okay, so in one candle, the market maker shift the zone, trapping lower level shorts for the rest of the cycle. Anyone selling this shit is now doomed, and I feel pity for him. Okay, these guys, they won't feel pity for you. They're like, they're happy, man. We have made 20 billion. We're getting our bonuses. Let's go for lunch. Next week I'm buying a Ferrari. These are their chance, how they think. They won't feel pity for you guys, trust me. Okay, so it now goes into level 1, where we have this box in here. So level 1 is used by the market maker to blow out accounts of traders caught in margin trouble with this what, false move in here, if they were trying to sell. Again, the market maker has induced more people to sell by breaking the moving averages in here and trapping them back. He moves into level 2 consolidation. He will move into level 3, creating an M formation inside the US session. You'll pull back. Okay, some of the stuff in here, I won't talk about it, the moving averages. I'll teach you the moving averages later. Okay, so as you can see, we have our consolidation, false move 1, 2, 3 to the low of the day. This is our shift bar. Okay, so market maker induce shorts and now trap the people from the low of the day. Okay, this move will make people to try to think that their price is going back to the low of the day, but it's not going back there. From level 1 consolidation, you enter into level 2, creating what, the high of the day in here. Then price will pull off to go back in the range. So as you can clearly see, this is our market maker pattern, the market maker cycle. this will be part of your homework, your daily cycle. I will need you to mark up your charts like this, showing off consolidation, the Asian range, everything. Okay, if you look from this, what is called to be level 2 consolidation in, we had 3 moves going into what? Into level 2. This is its job. 1 2 3 stop, drops 1 2 3, stops 1 2 3, stops. These 3 moves are done, creates an M, he pulls back. So this is our daily cycle. Okay, now I'm shifting over to the weekly cycle. Like I told you before, the same pattern which I drew on that black screen will appear over the course of the week. Okay, so if you are trading for this one, like I told you, I'm measuring on Forex. So our Forex week is 5 trading days. Okay, Monday, now Tuesday, Wednesday, Thursday, then Friday. So the first 8 hours of the week, which is the Asian session of Monday, okay, we will now have the Asian session, which is the accumulation phase. Okay, so price will consolidate at the beginning of the week. It now creates a false move of the week and comes back into the range. Okay, so this is Monday, Tuesday, Wednesday, Thursday, Friday. On Tuesday, okay, you repeat the law created on Monday, inducing more people, trapping more people. You will rise price to go back into what is level 1. Okay, this is now Wednesday. You drop price, then rise, it comes into what is level 2. So this is our first move, second move now. Okay, Thursday, same thing, it drops price, rises price, and creates the high on Thursday. Okay, so on Thursday, everyone is now saying that price is buying, let's buy. And this is where they make their biggest mistake. Friday, false move, week ending. I hope you remember that from this first slides I've shown you. You make a false move to the high, pulls back price, and inside the range. So this is what will happen if you look at this cycle over Monday, Tuesday, over Monday, Tuesday, Wednesday, Thursday, Friday. This is the same pattern which I drew on what? On the daily, as you can see in here. My eraser is not working. Yeah, this was our daily pattern. Now it's what? The weekly pattern. Okay, you need to understand that the daily pattern is the weekly pattern, is the monthly pattern. It's what? It's the only pattern which the market maker has and uses, is the market maker pattern. Okay, so let me talk about the weekly structure now. Let me pick another pen. Maybe, I don't know, I haven't used green. Let me try green. There's no one to reply to me whether they can see this shit. I'll go with black. I think black is good with the background. Okay, so what will happen with the weekly cycle is that the market makers trap traders on the first day of the trading week, which is Monday. In this case, if you are trading indices, volatilities, it's what? It's Sunday. Okay, so you accumulate. The market makers trap traders on the first day of the trading week and tie up your margin for the remaining days by aggressively moving away from the low or the high. Okay, so you accumulate in here. This will be the first 8 hours of the week. I hope it's clear. The first if I want you to think this from the perspective of the daily cycle. Okay, if the Asian session which was 8 hours on the daily cycle. Think of Monday as the Asian session of the week. I hope it's clear. And think maybe of Tuesday as the London session of the week, then Friday, Thursday as your New York session reversal. I hope I'm making it clear for you. So what will happen is now that the dealer will accumulate contracts at the beginning of the week, and now they will trade above or below the previous peak, possibly using it as the high or low of the current week. So if the low of the previous week was here, you will not come to this low, you trade on almost on the low, because if it comes here, he will he will release people trying to who were trapped from the previous cycle. I'm sorry guys, this shit is trying to increase. So the objective is to stay above or below the perceived support and resistance level for at least 3 days, causing exhaustion and panic. Think of this: you enter trade sell Euro USD, you've entered at the low of the week. Okay, you enter a trade in here, you are a seller. You will make sure that you will not come back to the same low for 3 days. This is what will create the 3-day cycle. This will be day 1, day 2, day 3. This is what is going to create the 3-day cycle. Okay, and will cause you to exhaust and panic because you've been in a loss and your loss is increasing. A lot of people will cut. I've been in the same situation where I was in a trade and I saw that, hey, I'm losing more, let me cut my loss, I can't take it anymore. In 10 men traders will cut their positions with a huge loss, or if the account is over leveraged, they will blow their accounts. Okay, which is margin call. We talked about margin call on the first slides where we begin this sheet. Okay, so understand that the weekly structure is the daily structure. Okay, like I said, the first 8 hours is the Asian session of the week. So let's look the weekly cycle on a 4-hour chart. This is a 4-hour chart. Okay, so I hope you can clearly see the cycle. Try to mark up the cycle before I discuss it to you. I'm going to keep quiet for a minute and then come back. Okay, let me continue. Wanted to mark up the cycle. Okay, like I said, so this is an H4 chart. This is an H4 chart in here. What will happen on the H4 chart is that you block the first 8 hours. Okay, then you draw a line running across in here. It's hard guys to draw a straight line. Sorry, you draw a straight line running in here. Okay, you can see this line, I already drew it in this line. So I draw at the low of the other candle and at the high of the first 2 candles of the week. The first 8 hours of the week is here. So first 8 hours is the accumulation phase. He has been accumulating contracts. Okay, so as he was accumulating contracts, he now evaluates and he sees that, man, more people are buying. Let's start. What do we need to start with? Okay, he starts with a false move in here, takes more people to go long. This green, this candle was green within this week. From here, it was green at one point, So people were seeing 3 green candles. I told you about 3. Many people believe in anything as long as they saw it 3 times. It traps them off the high of the 13 EMA, the red line. It will drop price in 3 pushes. 1, 2, 3. Creates the low of the week in here. Okay, so when the low of the week is created in here, your job is to wait for the second leg of the low of the week. Okay, he repeats the low of the week, try to enter at the low of the week in here. After he makes the low of the week, he will make a unidirectional swing for 3 days. Okay, sometimes it can be 5, sometimes it can be 1. It depends on what he wants, and it depends on how much did he move on that day. Okay, so this is the concept of the average daily range. So if he's moving 3 days in a row, it has to be 3 times average daily range, which will be 3 times what? ADR. Okay, which is the average daily range. So from the low of the week, he pushes very aggressively. If you have entered in here in 8 hours, you are up week. Unless if you wanted to turn this into a swing trade, you could. You hold it for the whole week. When it creates the high in here, you exit. 1, 2, 3 pushes. Okay, and now look for a reversal signal to end the week consolidation. I hope you can see the pattern and everything in here. It's clear, like I drew it for you. So this is the same weekly structure seen on what? On the 1 hour chart. Okay, so this was our Monday, first 8 hours. Let's block 1, 2, 3, 4, 5, 6, 7, 8. Okay, in here, this is our first 8 hours. This will be our what? Our Asian session of the week. Okay, it induces more people to try to buy this sheet, and then drops price in what? In 3 pushes. In here, the 3 pushes are not that clear, but you can see 1, 2, the third moves comes in here. It creates the low of the week. Tomorrow, look at this daily pattern: consolidation, stop hunt. Okay, he repeats the low of the week in here, creating a major W of the week. Like I told you, you will trade away from the peak for what? 2.5 to 3 days. This was 3 days. It creates the peak on Thursday, comes into consolidation on Friday. I hope you can see the cycle clearly and be able to understand how he forms the cycle. Okay, so this is now a 15-minute chart. The same thing is seen from the 4 hour to the 15-minute. Okay, consolidation, false move before the stop, and 1, I think, where's my pen? 1, 2, the low is created in a 1, 2, 3. Price goes back into consolidation. False move of the day repeated the low of the week in it. For us, this is a signature trade. It's called a 22 trade. I'm going to tell you everything about a 22 trade. Whenever you see a 22 trade that day, you should know that, yeah, I'm about to make money. Okay, it creates the low, goes into consolidation the next day, false move. Okay, the same thing, consolidation, false move, creates the high of the week, and a price pulls back to create the stop hunt into end of the week range. Okay, so this is what is happening. Is putting in the daily cycle into the week. As you can see, this was our daily cycle, the next daily cycle, the next daily cycle. So 3 daily cycles in one direction will form us a what we call a 3-day cycle. Okay, a 3-day cycle will start from a peak in here, moves 1, consolidation, 2, consolidation, 3, peak formation, it goes back. Okay, that's the 3-day cycle. I'm going to talk more about the 3-day cycle. The slides are upcoming. The same thing, this is now a 4-hour chart where of what we are looking at. I didn't draw the lines. I hope I'm going to draw. As you can see, the high is on the yellow line, the low is here. What it did is that this was our Asian session consolidation, induced more people to buy in here. It dropped price in 3 pushes. Black was better. It dropped price in 3 pushes, 1, 2, 3. Okay, as you can see from here, creates the low of the week, trade away from the low of the week. Okay, I hope you can see what I'm talking about, that the pattern presents itself over the course of the week, over the course of the day, and over the course of the month. The same sheet. So now we have this. Can you see white? White, how does white look like? Let me see first. White is clear. I hope you can see it. So what we have here now is the high of the previous week in here. So this is our week break in here. Okay, so our first 8 hours of the week Asian session, which happened to extend in the whole day, the whole of Monday, was what was consolidation. Okay, as you can see in here, there is no clear movement. Price is in a channel. Okay, on Tuesday he made a false move to the high, dropped in here, repeated the high on Wednesday. If you look at this, okay, they did not come to the high of the previous week. Why? Because he does not want to trade and to release anyone trying to buy this. Okay, price was dropped in here. Boom, 1, 2, 3. It creates the low of the week, which is the W, back inside the range. So if he is to rise up price next week, he won't come back to this low if he has enough volume. He will come back if he doesn't have enough volume. Okay, so the same thing. This was GBP USD. I was showing it to one of my students, Faith. So I told her to mark up the chart for me. She sent a beautiful markup. So after you are done with this video, please go and mark up this chart like what I'll say, like what I'll tell you. Okay, first 8 hours of the week in here. This is what our Asian box of the week. We now look for false move week beginning. 1, 2, 3. It taps the low again, inducing more people to sell. It will swing from this low in here of the week, and it happened to be at the 50 EMA, 50 moving average, exponential moving average. Okay, so it trapped people. Some people, when price breaks below the 50 EMA and it is 1, 2, 3 candles. If I still remember, I don't remember correctly, but there's something called 3 soldiers and 3 crowds. I don't exactly remember what is being said about 3 soldiers. Okay, is that price moves 1, 2, 3 red candles, you now look for sale. If you see 3 green candles, you buy. Something like this. 1, 2, 3. These are called 3 soldiers. I don't remember exactly which one is which. I read it back before when I was starting to learn to trade. They said 1, 2, 3 green candles, you buy, especially if they are of equal size. And if you remember, those 3 candles are what you call the vector candles. So don't fall for that shit. Okay, so this is our weekly cycle from the low of the week in here to the high of the week in here, which is the how. As soon as the low of the week is set, we are trading away from the low of the week. Your bias is now to buy. Okay, you are not trying to sell on the low of the week. We have 1, 2 pushes, 3 pushes, creating a high of the week back into consolidation. I think you can clearly see the pattern I drew on that black screen in here. So this is our weekly market maker cycle, is how it will present on the 1 hour chart. Okay, so this is our weekly market maker cycle, is seen from the 1 hour. Like I told you, first 8 hours we have what? Consolidation in here. Okay, force move to the high, repeat the high, pulls off. This is our move number 1. After the move number 1, please do not try to buy this. Okay, this is a DNC. Do not count the trend. The trend is now set a peak. You trade away from the peak. Your bias is short. This is why you see the green arrow cancelled in here. Okay, it's only after the second move you will try to buy, but it's more safe to try to sell. Okay, do not count the trend level 1 after the first move from the peak. The market maker has trapped more people. Sometimes you will not rise price like it did in here, you will just straight drop. Okay, as seen from the other side, consolidation, first 8 hours of the week, force move, repeats the low W, level 1 in here. Okay, this was our level, this is now level 2, peak level 3. So from peak to peak, every peak you see will be level 3. Okay, every peak you see is level 3. Anything in between will give you the 2 levels. So from this peak to this peak, we have 2 levels in between, and we have 3 moves. Level 1 consolidation, level 2 consolidation, level 3 peak formation. I hope this is clear. Do not try to sell this, guys. You will lose money. This is a do not counter trend. I know some of you will sell it, and I will tell you, did you listen to what I told you on the first day we met? You'll be like, man, I remember you said do not count the trend level 1. Please do not count the trend level 1. Okay, so this is our weekly cycle as seen from the 15-minute chart. This is a Monday consolidation, force move 1, 2, 3, repeats the low in here, price pulls off into level 1, stop hands again, price goes into what? Level 2, stop hands again, price goes to peak formation. Okay, pulls away. What is he expected to do on Friday? Force move, weak ending, do repeat the high again and comes back into consolidation. On this one, they came above the high they set on Friday so that they could trap more people on Monday. If you look at this after Monday, I think it went down. I don't remember the chart, but this is what is supposed to have happened. So this is now our weekly cycle is seen from the 4-hour chart. Force move week beginning, sorry, Asian session. Our force move 1, those 3 candles, 2, 3. He repeated the low again. After this low in here, this looks like a downtrend for most people. Price is dropping. Okay, so people will be trying to sell. He rise price, he strip the people, he comes back again to the low, inducing more people to sell, and then finally tripping them off. After that, see what happened on this. This is what we call a gap. Okay, so if you have sold in here, okay, and you had a stop loss in this gap in here, when the price opened above your stop loss, you are now in a loss. This was some news event. This was last year in December. I caught the move down though, as it was now a week ending. Let's look at this sheet, guys. We're now at the high of the week, he only used a 1-4-hour candle to create the high, and he escaped them, so he now goes back into the range. This is a clear market maker pattern. Let me draw it for you with a thicker penny. Okay, consolidation, false move, is now going down. Okay, repeats the low, comes to the high very fast, stays at the high for a short period of time, then drops price. There are no 3 levels in here. It's because the move was done fast using the news, which will happen sometimes. If you go and check on your history data, you'll see that this is not a new thing. Okay, still on the weekly cycle, first 8 hours of the day, consolidation. My pen is now thicker. So consolidation, false move to the low of the week, 1, 2, and in this one you can see 2 clear moves are the ones which are clear. Sorry, I labeled this wrong. Yeah, okay. So now let me see and try to relabel this. First 8 hours, okay. This, he breaks the low and he is now below the low in here, as you can see. I would consider this my push number 1. He breaks the low again, this is now my push number 2, and he breaks the low again, push number 3, pulls back, comes back to the low, creating a W. Price will rise for what? 3 days. But as you can see in here, we only have 1, 2 levels, then it drops. Why did he do that? I don't know. Sometimes it will happen, you only do 2 levels. Okay, next week will come, first 8 hours of the week, price will start to do the false move. So this false move up to here, this is our false move week beginning. As you can see, price did not stop until in here where it had this shift in. You now wait for the high to be created and trade away from the. After this candle pains, only try to sell, do not buy, because you're trading back into the peak. Don't trade back into the peak. Your only trades are away from the peak. Okay, because if you try to trade back into the peak where you stripped people, this is where the problem will happen. So if you look at this, the reason why I put this is that this was the 3rd move of the previous weekly cycle. So what it did in these 2 weeks is that the thing that was supposed to show over the course of the week, okay, now shows over the course of 2 weeks. So the weekly cycle become a 2-week cycle. I hope it's clear and it might make some sense that the fact that he rose price in here 2 levels with another level left, and he had to make a false move completing the previous weekly structure. That will happen even on the daily. You can see that at the end of the day you close only at level 2, level 3 will come the next day. That will happen. Consolidation as in session, false move, pulls back, repeat the high, 1, 2, 3, creates the low, trap more people on the pin, goes back into consolidation. This is a 4-hour chart. Okay, like I told you, the same sheet will show over the course of the month. Be away, consolidation, 1, 2, 3, high is created, price pulls back, repeats the high, price will, you are now trading away from the high of the month, the low is created, and then price goes back into the range. This is the same as the yearly cycle. Okay, so if you guys remember, in 2008, how old was I don't remember, but we had a market crash. I think I was somewhere 10-11 years. Okay, we had a market crash. This market crash, a lot of people, they blame a lot of things on the market crash, But if we look at the chart from the year of 2008, there is a clear market maker cycle. I think you can see it. This is a typical market maker cycle. If I had a textbook that I had to write, which I will probably do in the future, this will be the cover. This will be the cover. Try to analyze this on your own. I will tell you what I see. 1 minute. Okay. First weeks of the year, accumulation. Can you see the accumulation in here? Can you see the force move to the high? 1, 2, 3. It taps the high again in here. This was the high of the year. Okay, this is now the high of the year. So many people see that price around March 2008, price is rising. They start to buy. This looks like a continuation W. Look at this pattern. A lot of you, we have traded. I think you know this. It looks like a continuation pattern, but is not continuing. It comes back to the high again in 3 moves. 1, 2, 3. Goes back to the high. It's a work of art, man. These guys they are masters in what they do. Okay, price will drop from the high. This is where the market crash started, in here around July. This is where the crash started. Price was just dropping, goes into level 1, consolidate, drops into level 2. People get some hope, thinking maybe we'll get a pullback in going back up here, and some of them will try to buy in here. Probably they lost some more money, and we have some 3 moves aggressively to the low. Okay, 1, 2, 3, which happened to be almost the end of the year. Okay, the end of the year. False move end of year, creates a W, price comes up back into the range. Going into 2009, price made a false move, repeated the same low, and then went up. This is a clear market maker pattern. I hope you can see it. Let me put some bold ink for you. I know some of you say, hey, what's the which pattern are you talking about? This is the pattern, man. 1, 2, price drops, creates a W in here, back into the range. Price will repeat the low next year, making another W. It will come up again. This is what exactly happened on Euro USD between 2008 and 2009. Go and look at the chart. I don't create charts. So again, looking at this chart, I will try to explain a lot of things on this chart. What we have in here is the accumulation phase. Let me start on these numbers in here. GBP card M15, we have our ADR value. Pen is too big. We have our ADR value in here, which is the average daily range 384. He is not allowed to move more than 384. Sometimes he will do, but that is the range where we expect the high or the low to be formed after he does that. Okay, on this particular day he reached that number, so his range was now what? 476. This was during the beginning of the coronavirus. This was the day when you closed school. I sold this pair around in here and bought it here. Okay, so even if you had 0.01, this the smallest lot size 0.01, the smallest one, you would have been able to book around 35 going down. and then 20 going up, so you'd have made $50 only on one pair, especially if you understood the ADR. So considering the ADR, I told you before that the Asian range need to be what? 50 pips. You're saying, hey Tanaka, the Asian range is 90. Why? It's because the ADR range is what? Is high. So sometimes it will happen. But as you can see in it, this is tight consolidation. I don't know if you will not consider this as consolidation. This is what we call consolidation. Price is what is consolidated. We will now have our false move outside the consolidation. I told you sometimes it can be in 5 candles, sometimes it can be in main 1, 2, 3. I think the high, he increases it, he increases the high, punches out yesterday's high. This is yesterday's high in here. He goes above yesterday's high. Why? He's inducing the Joe Rosso breakout traders to buy this shit and then drops price. Repeats the high, but it does not come towards the previous high because he has a lot of money trapped which he does not want to release. On this candle, I ended my sell trade. My stop loss was here. I put my take profit exactly at around the ADR value in here. As long as this number turned, as long as this line appeared, as soon as that line appeared on my chart being red, I exited my buy, exited my sell zone, started to look for a buy opportunity. As soon as the green hammer painted, I ended the buy, exited my take profit at the moving average, which is the 200 EMA. Okay, I hope you are now familiar. This is the TDI indicator. We'll talk about the TDI later on the day 4. This is day 1. So this is basically what we have. False move, create the high, repeat the high, drops price in here. As you can see, level 1, level 2, push number 3. Okay, these were trades that I took. I am showing them to you. This was GBP USD again. This was GBP CAD. Okay, this was GBP USD almost during the same days, but this was before that one. Okay, as you can see, the range is 73, but as you can see, we have some tight consolidation inside the range, especially after in here where we need to evaluate our box. In here we have this box, we have our false move to the high of the day, price pulls back, creates an information, I sell in here. This day I exited in here. I did not hold the trade until here because I thought this was the end of the run. As I had made this was more than 73 plus 100, 170, almost 150 pips. I thought I was good. I missed the move. When I came back to my platform, I was disappointed that I missed this move, but there was nothing that I could do. Even if I had stayed in the trade, the close about the 13 EMA would have taken me out because I trade with the rules. Okay, the same thing. This is supposed to be Euro USD, if not Pound USD. I don't remember exactly. Consolidation in here. Hey, my lines are off. Let me try to draw them correctly. Consolidation, consolidation. False move to the high, pulls back, repeat the high. Okay, in here. This, I would consider this my push number 1. Price rests in here, tries to come back again to the high in here, but it did not come in here. It did not reach the high. Price drops in here. So we now have our 3 levels, 1, 2, 3 pushes down. Okay, I hope they are clear. This is our peak, our first drop of price, which made almost a retest in here. This is why I do not count it as a drop. The first drop, second drop, the third drop is in 3 pushes. This is what is called a 33 trade. You will see 3 pushes within the third push, so it is something like this, 1, 2. Within the third push, it will start to push 3 times. So this is just another market maker cycle within the third push. It's called the 33 trade. So we have some variations to the theme. What can you vary this guy? The only variations that he can do, the only things which he can change is he can change the sessions in which the moves come. So you see that consolidation sometimes will happen up to New York session. Okay, he can change the severity of the stop hand. You are waiting for him to create a 50 pip stop hand. On that day, you do a 17 pip stop hand. It's because of the money. Sometimes you console everything behind the news and announcement. You move price aggressively based on the news. The whole day will be flat. When the news comes, price will move. They will blame the geopolitical events. I told you an example of coronavirus. When the coronavirus lockdown started in USA, the euro and the pound, they went crazy. These things they were blaming on coronavirus. We had an earthquake in Japan back USD/JPY. We had some flash crashes because of an earthquake. They only use these things as the reasons. It's not that the earthquake caused price to move. No, price cannot move because in earthquake moves buildings, not price. Okay, so these guys, they use earthquake to move price. Okay, so like I told you before, the second most important element of this method is the timing, where I told you to map your own broker. Do not use the broker's time at the bottom of your MetaTrader form. If you do that and you try to ask me that, I'll be disappointed. I'll assist you, but I won't be happy. Okay, so convert the times I gave you to your local time. Okay, so now you need to identify the formations at the proper times. Don't get confused with the ribbon at the bottom of the broker platform, which is the safest time. It's not the trading times. Okay, so like I said before, there are all other time reference. If you go and Google trading sessions, they will give you some session timings. Those timings, I don't want to say they are wrong. Don't use them. Okay, so like I said, we have what we call a Brinks trade. Okay, so a Brinks trade is that we have the two most telling candles. Okay, so what will happen in the Brinks trade? So Brinks trade is a guaranteed trade. Okay, so when you see this trade, you're almost certain and sure that you're going to make money. What will happen on a Brinks trade is that price will consolidate, force move 1, 2, 3, pulls back. This second leg in here, will be formed around 3:30 to 3:45. Sometimes it will be 4 o'clock. 3:30 to 4 o'clock, that's the maximum time. If the second leg is formed at that time and the trade is confirmed, so now we are having the pattern in conjunction with the timing. Price will drop 1, 2, 3, pulls back, comes back. Okay, towards the US session, 9:30 to 10 o'clock, sometimes 10:15, 10:30 is too late. Okay, price will set the second leg on the US session opening, which is the 9:30, and goes back into the range. So whenever you see a second leg of an M or W formation being formed in line with the session opening, know that a Brinks trade is setting up. Okay, so like I told you, the market makers, these guys, they have their own limits. They can't destroy the world. They can't continue to sell euro because they need to make profit. They are limited in what they can do. So if you know their limits, you own them. Okay, market makers are limited in what they do. They have restrictions placed on them by the IMF and the World Bank. So that's why the ADR is a useful tool. The average daily range, you know that today is average daily range is 100 pips. Okay, you might move 40 or you might move 200, but it's an average. Okay, they can only move a pair or about 200 pips a day, which is the average daily range. This is the weekly average range, 600 pips per week. Okay, so they also do not have unlimited equity. When they buy, they need to sell, but they need to get some of their money back. Okay, they are limited by the weekly net change and the allowance. This is why price goes back into consolidation most of the times. Okay, price comes in here at $50. Okay, beginning of the week, price will drop, make a W, make a high, goes back at $50. This might be $2. The numbers are too big, guys, don't consider them. This will be $30 maybe. Okay, you always go back into consolidation. So what will happen at the end of the week? There will be no change. If not, they will destroy the world economy and trade balance. Okay, so the market makers, that they are, since they are limited, they only have some few moves which they can do. They can hit the stops ups and down, which is the force move we talked about in here. Force move up, force move down. Okay, they can now reverse of the high or the low of the intraday trend, reverse of the high or the low, reverse of the low or the high. Okay, they will other thing which they can do is that they will set the range in here. You are waiting for them to drop, they will just do a straight away. This is what we call a straight away trade. There's no stop and inside the Asian range, price will just rise. Okay, this is the second option. The third option is to test you with timing. So what you are doing here is that you are waiting to enter a trade, thinking that the stop and will come on London session. It won't. New York session will come the first 2 hours of New York session. So the price, the whole day price might be consolidating. This will be testing your patience, and you will do the force move inside the Asian session. You will see it if you go and look of these things which I'm telling you in the charts. Okay, so we now have the market maker moves where we have the count. I told you if you can count from 1 to 3, you are able and eligible to make money. So these are based on trader psychology, where I told you anyone who saw anything 3 times, they will believe it. Okay, they are based upon fear, greed, and inexperience of traders. Okay, so the market maker will use these things to make sure it kills you. There are intraday counts, which are counts on the daily cycle, and counts over several days, which are counts over the 3-day cycle, counts over the 3-week cycle. Okay, they are all trap moves to grab your equity. Like the reason why it does, do not associate these counts with Elliott waves or any other indicators. These are just levels and zones. Okay, so market makers will create some zones from a peak. Market makers form zones or levels to trap traders book profit and hit their stops. Sometimes they'll be very easy to identify, looking like stairs. Sometimes they will pick formation, drop level 1, drop level 2, drop. Okay, sometimes it will appear something, sorry, pen went too fast. Peak formation, okay, level 1. This can, I hope this you can see that there's a level. Sometimes it will be very hard to see the levels, but when this appear like this, know that it's in level 3, is making a W and back to reverse. That is the next move. Okay, so sometimes it's easy to identify, sometimes it's not. Remember, at level 3 you will see an aggressive move. Okay, there are 3 levels of drop or rise over 3 days, which will create the 3-day cycle, which is the cycle that shows off from Tuesday to Thursday on the weekly cycle. I drew that for you. The level 1 is market maker driven. It's a fast move. Why is level 1 a fast move? Okay, let me draw this for you. Peak formation in here. Level 1 is a fast move because he is running away from the trapped traders. is trading away from these guys, he needs to move away from them because he has trapped them. You will go into consolidation, which will be level 2, sorry, level 1 consolidation. In level 1 consolidation, I told you, do not try to sell the shit because you are going to the peak DNC. Do not counter trend level 1. Okay, so now we have a stop, and from level 1 we now go into level 2. Okay, from level 2 we now go into what? Into level 3. Level 3 is aggressive like level 1. Level 3 is called the pump to dump move. So what they are doing is they are pumping price to dump it. They are pumping. You are getting a buy sentiment in the market, and it reverses price of the high. It traps you with an M or a W formation. Okay, understand that level 2 is the only level which is not market maker driven. It's driven by retail traders, but you will interfere if these guys start to do something which it does not want. Okay, so during these 3 levels, the market maker will buy from traders to create positions with the heaviest position seen at level 3. Like I said, during these levels in here, the market maker is a buyer. He buys, you trade, he buys from you, you are a seller. You buy, he buys, you are a seller, he buys. So now he is heavy buying. Okay, more people are what? He is heavy on the buy side in here. He is buying. What does that mean in here? More people are trying to buy, and he has more contracts being sold on the opposite side. Okay, because many people are seeing that price is increasing, it's rising. Okay, they try to buy, it creates an M, then drops price. So what will happen is that when the signal appears, what this simply means, or it was all about from the beginning, when the signal appears, simply buy or sell the third level, drop or rise. Okay, only when the signal appears, the third level, drop 1, 2, 3, you are now a buyer. You don't buy here, you wait for him to make a W, you now buy. In here is the same, 1, 2, 3, you don't buy here, you wait for him to create an M, you buy. Guys, I know some of you will sell this, trust me. You are watching this video and you sell this shit. Don't do that. Always wait for the second leg. If it doesn't give you the second leg, it's fine. It does not qualify to be a trade. You will see that. Like I told you, if you can count to 3, profit will be realized. Each one of us can count up to 3, and on the count, in addition to each of the 3 levels, there's a corresponding level of consolidation. Most of the times the stops will be triggered before the next level is started during these zones. Shit, it's not showing up. I wanted to pull off the other sheet. Okay, so most of the times the stops will be triggered before the next level is started. During these zones, 20 to 30 pip swings are seen. Market maker is trying to hit stops both ways and making easy work for the next level move. So no or buying selling pressure is being created from the market. This is what I mean. Okay, let's go this way now. Peak formation M, consolidation level 1, corresponding level of consolidation L1. We are now in L1. Before he moves to L2, he will rise price, then drops it into L2. Before he moves from L2 into L3, he makes a stop and high into what? Into W formation. He goes back into what? L1. So this was now our level 2. This worksheet, the W, is our level 3. He makes the stop and in here, pause off. This is how he moves. He can't just rise price from here without clearing and taking out anyone trying to buy. Okay, So understanding that the consolidation zones created during these moves are to create force support and resistance visible on the charts, so that you buy support or sell resistance, then you get killed. Okay, so what will happen is that you need to buy or sell stop hands against the head, but in line with the market maker moves, which is why you are here. You are here to trade with the market maker. Simply buy the third level correction and sell the third level rise to grab easy profits. I drew this for you many times before. Let's move. Understand that at level 1 and level 3, aggressive moves will be seen. Like I told you, level 1 is more aggressive. Why? Because it's moving away from traders. Level 2 into level 3 is more aggressive. Why? Because it needs to trap the last people on the cycle. Or this is what I mean, peak formation. From this peak, you rise very fast. This is an aggressive move. Go back into what? Level 1. Pulls stop and in here. This will be our level 2. Will look something like this. It won't be that aggressive. Okay, understand that this is a typical one. Sometimes you see level 2 only being the most aggressive, level 1 and level 3 not being aggressive. Price will pull off, then you create the high, with the third move being aggressive. These are aggressive moves. Price makes an M formation in here. Okay, the reason why the first move is aggressive is because he has trapped people. He needs to blow their accounts, put them in margin trouble, book profit. Okay, and at level 3, this is where you see what is called a head and shoulders pattern. Okay, so what will happen is that you have a peak in here, 1, consolidate. We're now in level 1. This can be seen on the 15-minute chart over the course of several days, or the 1-hour chart. We'll talk more about levels. Stop and 2, okay, stop and in here 3, you do this. Okay, he set the high of level 3. You pull off. If it did not trap enough money in here, it will come up, breaking the high, pulls off, repeats the same high of this first high. It won't come to the second high, creating what will look like head and shoulders pattern. So this will be a shoulder, this will be a head. It looks like a human being. Okay, then this is now what? A shoulder. So we are having something like this. Guys, I can't draw. This is our head, this is our shoulder, this is our shoulder. Okay, shoulder, shoulder, head. I hope you now understand what a head and shoulders is. Going the other way, it will be something like this. The reason why it's created is only because the second leg of the W was much higher, was lower than what? The first leg. He had to induce more people to go short and trigger more stops. And that was the only reason why the head and shoulders appears on the chart. So never trade against the peak formation out of level 1. I told you DNC, that's a suckers play. Okay, from level 1 you are only going with the trend. Do not go back to the peak formation. Level 1, do not try to sell this. Even if he does this, do not sell. Wait for him to come in here and you buy. Okay, you go into level 2. Level 3, do not. Level 1 consolidation, do not counter trend. Straight away trade develops here where he wants to blow people's account and he is trapped enough volume. Okay, so the market maker is what the market makers have what they need, and they have the trap volume. The other thing on the count is that I don't want you to confuse the 3 swipes at the stop loss levels, which is the stop and, with the 3 levels of rise or drop. Okay, sometimes you see that from the consolidation agent box. Okay, what will happen at the 3 swipes? There will be small moves, 1, 2, 3. Okay, if it's a straight away, it will be something like this: consolidation. The 3 moves which I'm talking about, the 3 levels of drop or rise, will be 1, 2, 3. This will be big gigantic moves. Okay, something like this. 1 2 3. They will be big moves. They are not compared to this. Okay, so something like this. This is the 3 swipes at the stop loss. Okay, 1 2 3. You create an M formation, then the 3 levels of drop or rise will come. I hope it's clear and you won't confuse. Some of you will see the 3 levels of rise or drop as a stop, and sometimes you get smoked because of that. That's why I thought maybe if I could put a slide and why guys, this slide was not supposed to be on this page. I don't know what happened. I put it on day 4. It's misplaced, but these 2 slides are not supposed to be in here, the rows to profit. Let's go to the homework section. So your homework for day 1, I want you to basically go on a chart and mark me this thing, which is the consolidation / accumulation vector 1 2 3. Mark the M formation, the shift candle 1 2 3, the W. Okay, so you mark up this pattern on the daily, the weekly, the monthly, and the yearly. I want you to send me 5 5 5 5. This is what I want. This is not what I want you to. This is not a limit. This is the minimum you are supposed to do. It's obvious the person who would do 30, we have to see 30 variations than the person who did 5. So someone, this is 6 times more than 5. You are doing yourself a disservice if you won't do it. Okay, this will be your homework. I will attach another PDF for your homework. Okay, so thank you guys. This marks the end of our day 1. I hope you now know the market makers, what they do, their patterns, and why they appear and how they create them. Okay, peace guys. I hope to see you at the end of the trading course. Okay, so good night guys.